Rick Tidd of Bowers and Company. I have to include my disclaimer at this time that the opinions of those who are present, I'm sitting next to an attorney, and that's why I'm saying this, the opinions this morning are from the members themselves and not necessarily reflecting the Business Journal News Network. What we'd like to accomplish this morning, I think, are really three things, and this comes from 53 years of business experience in the Syracuse area. One is focus on the question of planning. Two, the question of requiring a team in order to accomplish your end goal. And three is the question of allowing enough time for the process to occur. So without ado, I'd like to begin the discussion this morning, and I'm going to call on Tom Agnello to start. Tom?
Thanks, Norm. That was a really great introduction. My name is Tom Agnello, and I'm a partner with Madison One Clearinghouse Network. Madison One is actually a network of professional advisors, a global network of professional advisors that include professional service firms such as accountants, lawyers, wealth managers, investment bankers, and M&A advisors such as myself. I also have my own company, M1 Advisors, with which I work with directly with business owners on the successful transition of their businesses. So now we'll go to the 10 key areas. We just want to make sure that these are the areas that we're going to cover today. Which exit options are available, how to develop a long-term exit strategy, how to identify the key value drivers in your business, how to determine the current wealth of your business, how to enhance your business worth, how to turn the value of your business into immediate hard cash, what buyers are looking for in an acquisition, what are the tax implications of exiting a business, how long the process may take to complete, and what are your responsibilities as a business owner in the involvement of your time required throughout the process. If you have questions throughout the presentations, if you can please enter them into your screen, and at the end of all of our presentations, we've allowed time to address those questions, and if there's a specific speaker that you would like to have, just address that question directly to them, and again, your confidentiality will be maintained. Please consider the following. Over 50% of privately owned businesses will change ownership in the next 15 years. Over 75% of these business owners don't have an exit plan. The landscape is evolving into a buyer's market with the flexibility in SBA loans and other types of instruments. Buyers today are finding that it's a buyer's market and there's a lot of opportunities for them to select from. The small business owning baby boomers will begin to exit their businesses over the next 6 to 7 years, and we think it's going to continue right in through the 2025. It's also been said that there's over $10 trillion of personal wealth that's going to change hands in the next 8 to 10 years, and that's typically either going to change hands through a family transition or an outright sale of the business. Another interesting fact is 80% of the businesses are not saleable in their current state. 64% of the businesses have no plans to minimize capital gains. And most Americans spend more time planning their vacations and holidays than planning for the smooth transition of their business. I know many of the speakers that are here today will agree the number one question that we like to ask most business owners that typically they don't have the answer to is, reminds you of that one commercial, what's your number? They typically do not know exactly how much money it's going to take for them to retire comfortably and to continue to remain comfortably retired. There's only 4 places your money can go when you exit your business. We try to minimize the amount that we give to the government, but your professional advisors will work together with you to decide whether it's appropriate to donate some to charity, donate some to family estate, and then the balance to continue your lifestyle. Typically, 50 to 75% of all business owners, their net worth is tied up in their business assets, and it's necessary for them to sell their businesses in order for them to comfortably retire. It takes a cohesive team approach. It's a little bit like it takes a village. You really is no one professional advisor has all the answers. We like to think that it's a team of advisors that includes your trusted advisor as an attorney, your CPA, your valuation expert, an M&A advisor, a good tax planner to minimize your capital gains, family office, wealth advisors, and especially if you're looking to do a transfer within the family member, a bank loan officer that can help facilitate one of your children cashing you out. Any of the questions that a typical business owner has and some of the concerns they have is, who should I transfer my business to? Family, employees, partners, or a third party? And again, working together with your trusted advisor, we help you ferret out those choices and which one would absolutely help meet your personal and business goals. When's the right time to leave my business? What is my business really worth? What's the right deal structure for tax avoidance and avoiding future risk? And how do I ensure that I meet all of my future goals and expectations? All four of us have worked with family businesses, and this saying probably goes without saying. The greatest threat to any long-term survival and success of a family business has less to do with what's going on outside with customers, competitors, and technology, and it has more to do what's going on inside with the relationships, the politics, et cetera, among key members of a family business. When we take a look at the landscape, there's really three different types of buyer groups. The first is private equity groups, the second is financial, and the third is strategic buyers. Private equity groups, management is their number one focus. They may take a minority position in a business to get their foot in the door. There's many of these private equity groups out there to select from, literally tens of thousands of them around the world. Many of them will focus on specific industries that they'll acquire firms, and they'll aggregate those firms together. They have the ability, because they have investors, to do a majority recapitalization of a company. We also find they may not always be the highest priced buyer. They're sophisticated negotiators. They do several of these transactions every year, sometimes every month, and they will take a very active ownership in the interest in the ownership, may ask for board positions, et cetera. The second financial buyer is predominantly a passive partner. They're looking to get a better return on their investment than either what the stock market offers or CDs, et cetera. They typically have no interest in managing or operating the business. They're a hands-off type of operation. And management is going to be particularly important because they want to feel secure that their investment is earning the return on investment that they had hoped for. The area that I specifically focus on is strategic buyers. Strategic buyers typically offer the highest price to a seller. Oftentimes, they'll purchase 100% of the ownership. They may be seeking, we have to be very careful too when you look at a strategic buyer, because many of them are comprised of your competitors. So we want to make absolutely certain that you have your confidentiality agreements or your non-disclosure agreements in place before you even open the door to let them know you're for sale. They'll also look for efficiencies in operations post the close of the transaction. Again, they're looking for better ways to drive more EBITDA into the business, more cash flow, and actually look for a better return on their investment by squeezing the inefficiencies out of your operation. I just had one strategic buyer that acquired a company, and the first thing that they did was basically clean house of all of the management team and brought their own senior management team. So the senior management team may or may not be critical, and if you don't put it into your buy-sell agreement with a strategic buyer, if you have an interest in your employees, you want to protect them, it's very important that you put those things into your buy-sell agreement. So why do you hire an M&A advisor such as myself from M1 Advisors? First of all, I help to coordinate the overall professional team of advisors. I work together with the attorneys to make sure that we have the right confidentiality agreements, that all of the documents are prepared, both legally as well as the CPA reviews all of the financial information that we aggregate. And I put together that type of thing into a package or a book, so to say, that is again distributed after all the confidentiality agreements are approved. We tend to help negotiate the best and highest price available. We'll seek out those strategic buyers and look to those first. We try to gain maximum exposure through Madison 1. We get global exposure to literally thousands of potential buyers. And we allow management to focus on the business, what we focus on the most important part of the cycle, and that is helping them to get maximum exposure of the business and to properly market and sell the business. You benefit from an experience of a seasoned professional, somebody that's got that been there, done that attitude and experience. You avoid pitfalls in the negotiation process. I try to do as much work up front so that the deal doesn't fall apart in the due diligence process. I've seen too many deals fall apart in the back end because they didn't do proper maintenance of the deal up front. So I try to work very closely with my clients to really determine, are they ready to retire? Are they financially stable enough? Are they going to have enough money to continue their lifestyle? So I try to do all of those things up front and bring the best and most qualified buyers to the table. I try to also have buyers compete against each other. So you're bringing to the table a number of qualified buyers, strategic buyers for a company. And again, the most important thing that I feel, as Norm said in the beginning, we want to maintain complete confidentiality in the marketplace. Upstate New York is a very small community. People don't like to have other people know that they're thinking of selling their business. So everything is handled very confidentially. When we talk about financial and mental readiness state, as I mentioned, I spend a great deal of time asking a business buyer. I've had probably 20 or 25% of the clients that I work with refuse to sign them up because I don't think they fully understand the implications of retirement. I personally have retired 3 times, and every time I come back to work, I keep thinking about, what I'm going to do for my next career. I do think that spending time up front to make sure you're mentally ready, you know what you want to do after the deal is closed, if you're not going to be involved in the business. I ask the personal questions: do you want to travel with your spouse or your significant other? Do you want to do volunteer work? Do you want to get onto boards? So I try to make sure we take a look at where do you, and the question I ask is, where do you see yourself 4 or 5 years after retirement? Where do you see yourself? What do you want to do? What really excites you and your significant other? The other part of what I bring to the table is benchmarking your company to industry peers. I use an application called Core Value, and what Core Value does it's a patent pending look at 18 different critical success factors in your business. It'll look at growth, recurring revenue, dominant market share. Again, these 18 KPIs are identified, and I take about 4 hours with a business owner. I mean, the software company says you can do it in an hour and a half. I really find that either by sitting one-on-one with a CEO or sitting down with their management team, going through the 350 questions about the business, you really do an in-depth analysis of all of the different intangible parts of the business outside of the balance sheet and income statement. It's important that those numbers are entered in up front, what your EBIT is with all the add backs and what your revenues are, but more importantly is how strong is your management team, how good are the HR processes that you have in place, do you have all your legal agreements in place, and what it does is it goes through these 350 questions, and then it will aggregate and score your company on those 18 different business metrics between 1 and 100. Okay. And here's an example where it's going to tell you where you're strong and you're weak on these 18 different areas. And in this case here, it'll actually come up with a value gap. And those operations, sales and marketing, financial, growth, and recurring revenue, as you can see, there's over $2.5 million that will contribute to that $5 million of value gap. So in this particular case, this company, if we were hitting on all cylinders and it was operationally perfect, it would have a value of about $12.7 million. In this case here, based upon how the client had answered the questions, it's estimating that their current value is worth about $7.5 million. What I like about this particular software package is this process that when you work with a client to sell their business could take literally months and years to complete. It will give you the opportunity to clean up your company and to be able to focus on those areas of your business that will add maximum wealth. I've actually had clients that will take these specific areas of the value graph for those KPIs and assign them back to the senior executives in their organization. So example, sales and marketing, if I could drive an additional $500,000 of wealth by improving my sales and marketing, it will actually come up with specific tasks that I can assign to my sales and marketing executives, and over a period of time, as they achieve those tasks, it will add value back into the company. The last area I want to address today is the value drivers and detractors in your business. The things that will add value to your business are these various components on the left here. EBITDA and EBITDA with the add backs, those country club memberships and the other things that as small businesses we take advantage of. That's going to be the biggest trigger to value. And within your industry, it could be a multiple of 3 times all the way up, if it's a strategic sale, up to 8 or 10 times the EBITDA. Excellent customer lists. I've had clients that will specifically, on the buy side, specifically look for clients that have a robust customer list in a specific industry. So they'll look to acquire that customer list in a specific region. Customer concentration. It's always good to have a wide variety of customers. Where on the detractor side, if you only have 2 or 3 clients that are driving 75 to 80% of your business, that's not a really good thing for value. Product differentiation. You know, are you driving a lot of innovation into your products, and you have a good defensible market position? Are you protecting your products and services with copyrights and with intellectual property, patents and things like that? Do you have a dominant share in the market? The technological and proprietary processes, again, have you got those copyrighted or patented? The location of your business. On the detractor side, again, if you're losing customers, if you've got outdated technology, your labor force, you've got employment issues, those are things that are going to detract from the value of a company. I think that's it for my presentation. If you have questions, again, I'll be available towards the end, and we'll be able to address those questions. I'd like to turn it over now to Rick.
Before you do, I just want to ask, you're talking about representing sellers in this case, but you also represent buyers?
Yes, I do.
Okay. So you understand the mindset on both sides of the table?
Exactly.
Okay.
It's great when you're hired by both of them. And I actually did a local company here where I was representing both the buyer and the seller, and it was great. Both of them were women business enterprises. They joined together, and it's great when you can say 1 + 1 = 3. It worked out to be a great marriage, and they both have commented on my LinkedIn profile of how fair and equitable they thought the negotiations went. I'd like to say that I'd like to come back after a year and have both owners, the owners of the buyer and the seller, say, you know what, this was a great deal that we put together 12 months ago. Thanks, Norm.
Thank you.
Rick?
Thanks, Tom. I appreciate it. Makes me ready to retire. There's some good ideas.
Not yet.
Not yet. Not yet. I'm going to start right out with a question that I often get, probably about in the top 3 questions I get from clients, and that is, how are you going to value my business? You know, what is your approach to valuing business? So really, in any business valuation that we do, there's really 3 approaches that we would look at in any business valuation. That would be the asset approach, the market approach, and the income approach. And there are subsets within all these approaches that we'll take a very brief look at today. So first, we'll look at the asset approach, a very common method to business valuation, probably not the best method to business valuation, but very common. It really looks just like the book value of the business. It makes no attempt to include or correctly value many of the assets. It doesn't bring any of the assets to fair market value. It doesn't take into account any intangible assets that may be there that are not recognized on the balance sheet. However, we do see this in a lot of shareholder buy-sell agreements, probably because it is so simple. Not necessarily the best way to do it. And for estate purposes, the book value method is certainly, in most cases, does not represent fair market value for estate purposes. So if we look at a simple balance sheet, we can see down at the bottom of 2010, we have stockholders' equity of $4.4 million. Under the book value method, that is the value of the business. So you can see there's really no adjustments made. It's basically taking your financial statements, looking at equity, and saying that's the value of my business. The next approach under the asset approach is the adjusted net asset method, or the going concern method. In this method, it gets a little better that the assets and liabilities are restated to fair market value. This is very important when you have a balance sheet that has a lot of land and buildings, equipment appraisals become very critical in very capital-intensive industries. We see this approach used in, say, holding companies or real estate partnerships where there's a lot of land and buildings in there. And as you can understand, this can be costly due to you have to hire appraisers to have the real estate valued up. So we have clients that sometimes don't understand why we need to do this method because the appraisals are costly. So it depends on what we're after is whether we use this method or not, but it is a valid method to use. So again, we look at an adjusted balance sheet. So we have our historical numbers on the left side that we started with. We make some adjustments to the balance sheet to bring, say, the property, plant, and equipment to fair market value, make some adjustments to cash surrender value and goodwill. We see now the value or the fair market value of the business is $7.7 million. So it's a little better. We've got our assets and liabilities at fair market value. So I think we're a little better off than using just the standard historical method. As far as income approaches, there's multiple income approaches that we use to value a business. We use net income, we use cash flow, and there's multiple methods within those income approaches. For the most part, we use cash flow. Cash flow is really the way that most businesses are valued. You know, the old term that cash is king is true, and most of the data that we use is based on net cash flow. There are some different methods under the income approach. You may use cash flows of historical basis or projected basis. We usually will use historical based cash flow projections if we have them, if we think they're good. The problem with using projected cash flows is that sometimes it's difficult to get clients to give us projected cash flows or to obtain them. Sometimes the internal management doesn't have the ability to do projections. But sometimes we found that when we value businesses, that it is necessary to do projections because, for example, if your historical cash flows don't represent what is going to happen in the future, then we would have to use future cash flows. For example, say you open a new division of your company and things have changed so dramatically that your historical numbers don't represent future, then we would have to do some type of projection. But as far as the income approach, the cash flow method really is, in most cases, the method that we look at to use. So we see, just as an example, on a simple cash flow statement, we have a sample company here. So 2010, we see the net increase or decrease in cash at the bottom of $50,000. That would kind of be our starting point if we were looking at a very simple one-year estimate of cash flows. And on the next slide, we see that we went through and made a few adjustments to the cash flows. We added back dividends. We made some adjustments for asset sale proceeds and legal settlements. So what we're really doing is looking at your cash flows, and we're trying to decide what is normal, what is reoccurring, and we are trying to remove those items that are odd, things that we don't think will happen again, to try and get a picture of what we expect will be the cash flows going forward, because the valuation is always forward-looking. So we would make the adjustments, most likely would tax affect the cash flows, and then we would come up with some type of capitalization rate. Here we use 13% to get a value of $1.5 million. Now there's a couple things in here that are not addressed and would make a little difference if you have, say, a pass-through entity, an S-Corp, or a partnership. There are issues regarding valuation as far as, so that topic is not covered here, but it is a consideration to look at for pass-through entities, whether you tax affect those cash flows or not, and it's a very important issue because it changes value dramatically. And the final method that we would look at would be the market approach. Generally, two ways that we would value under the market approach, and that would be looking either at public company data or private transactions. I can tell you from experience that to look at public company data and try to bring that data to a very small, often private company is very, very difficult. Public companies are very different than privately held companies. They're very large. Most of them hold multiple lines of business. So it is very difficult to compare a public company to a private company. However, under the private transaction method, we do find that we can find often similar companies that we are valuing, so we can compare what another company was sold for that is similar to the company we're valuing. For example, you may have a grocery store that you would like to sell, you're getting ready to retire, and we may very well be able to find similar transactions that have occurred with small grocery stores in the Northeast with sales of, $2 to $3 million. So we try to make these as comparable as possible to see what is the average selling price of a small grocery store in the Northeast with certain sales. Sometimes we are successful in finding them, sometimes we are not. There are some industries that are more prone to sell at certain multiples. For example, accounting firms, payroll companies. There's a lot of data. Sometimes there is no data on certain industries, but we can usually find one or two to at least see if we're in the right ballpark. A couple other things that I'll mention that are not in the slides and may or may not be relevant, sometimes in transition, but certainly for estate and gift purposes, are discounts. In most cases, for transactional purposes, you won't see these unless you are transferring maybe a less than 100% ownership. But just a couple things to consider. Valuations, we would consider discounts for lack of marketability, meaning that the private company is not readily marketable. You cannot go to your E-Trade account and click on your company and sell it like you can IBM. So by definition, it's not marketable. And like I said before, if you are valuing a less than 100% ownership interest or an ownership interest that does not have control of the company, you may consider a discount for lack of control. We often see that in, say, a 25% shareholder that wants to retire. He wants to get out. He wants to know what is his 25% worth. Well, it's not as worth as much as a 51% owner, so there is some discount in there for control. And with that, I think that wraps it up for me.
Well, before we transition to the next speaker, I'd just like to let the audience know, since I know you're all sitting on the edge of your chairs wondering, gee, how do I get access to these slides? We will send you a link so that you can follow this presentation at your leisure. And also, Rick was so eager to get into his presentation, he didn't tell you he was a CPA at Bowers. And he has so many initials after his name that I can't repeat them all. But in any case, valuation is a prime focus that he has. And now we'd like to transition to someone who wears two hats. She is a partner in Mackenzie Hughes, so she's an attorney and a CPA. So, Mary Ann Cody, if you would please.
Thank you very much, Norm. I'm very pleased to be part of this presentation today. I think that there's valuable information being provided, and I'm looking forward to passing this on to my clients. What I'm going to talk about is some general ideas from a legal perspective as to the transitioning of a business. And I believe as Tom has mentioned, as a business owner, once you've been successful for a couple of years, whether you're 35 years old or whether you are 65 or 75 years old, amongst all the many things you need to be thinking about, we need to be thinking about transition in the future, where you expect your business to be going, who you expect to be selling it to. As you're thinking about your business, of course, we need to keep in mind what type of business that we have. There are certain limitations, of course. If we're talking about a professional corporation, if you're a dentist, that certainly limits who you're going to be selling your business to other people with that same licensure that you have. We also need to keep in mind, let's say, for example, that you are a partner in the business or you've purchased the business from someone else. We need to keep in mind what restrictions are in place right now. We can have the best transaction put in front of us for the sale of the business, but if someone pulls out at the last minute an agreement that you have signed that is limiting your ability to sell, then we certainly aren't getting too far. So we need to look to see what current shareholder agreements are in place, whether there's any buy-sell agreements in place. And by the way, if you're not even thinking of selling at this point, or that's something very far on the horizon, these are documents that need to be in place. If we have a corporation, we need to have a shareholders agreement in place. Perhaps if we're the sole owner, not quite as necessary to have, and certainly a much simpler document than if we have partners in the business with us. That when the company is formed is the time to have those agreements in place. I've seen too many times when one partner has passed away, and it turns out none of those documents were in place, so that makes the transition very difficult. So as you're thinking about selling a business, again, as I believe has already been mentioned, what special certifications are there? Those certainly keep in mind that, for example, if we do have the minority or women-owned business certification, and if that certainly is a key factor in the success of the company, that's something to keep in mind. The sale, we need to keep in mind if we have any deferred compensation agreements with key employees, what trigger there would be for a sale of the company. That certainly is something to be keeping in mind. In general terms, if we're going to be selling the business, if we have a family we wish to gift to, we'll talk about gifting. We'll talk about selling. Selling obviously to a third party, selling to key employees, and of course we can keep in mind that we also can be selling to those same family members also, or some combination of all of this may make the most sense. If we decide that we want to gift a business interest to a child, 3 initial considerations we should be aware of: whether that child is currently active in the business with us, whether it's appropriate for that gift to be outright, and if there's other children that you also want to be beneficiaries of your wealth, how we best arrange this. I have found over the years that I have been doing this, transactions are the most successful when we are dealing with transferring wealth from the senior generation to the next generation. Is the more disclosure that there is amongst the family, the better the transactions go. Even if we start as early as, let's say the business owner is in their 50s or 60s, the children are just getting out of college, not sure exactly where they're going to be going, starting family meetings right at that point just to have discussions about how the business works, to pass on, which I think is very important, the history of the business, how it got to be where it is. If the children aren't aware, grandparents started the business and exactly how that went. I think the earlier that is done amongst the family, the better this all gets, as opposed to the children finding out when their parent has passed away exactly what the wills and trusts say and exactly how the business is going to be divided amongst them. That can be for a very difficult transition. So disclosure, I think it is key to the best that it can be done. If we're going to be gifting to a child that is now in the business, again, an operating agreement is very important to have. The operating agreement is the document that we go to see exactly how the relationship is going to be amongst the shareholders. If there's no operating agreement in place, then we fall to the default statutes. But again, you would rather decide your own terms than have the New York State law be the default for you. Oftentimes, we look into doing a gifting program to children over time. This can start with a recapitalization of the company, gift from voting shares into non-voting shares. And oftentimes, we will advise the senior generation to start on a trial basis, to start to give shares to the generation and see how it goes. Very important with any of this, as Rick has said, is a valuation. If we're doing a recapitalization of shares and we're going to be doing some gifting, valuation is going to be key. And when we have inter-family transactions, the discounts that Rick talked about are going to be very key for this, and that's why this is very much a team approach to have all your financial advisors in place. Oftentimes we don't have a member of the next generation that is in the business. We want them to have the benefit of it, but they are not active members, and we certainly don't want to be forcing someone who is not in the business to have a career change when they're in their late 40s and all of a sudden start running a business that they have no idea about. There certainly are ways to have that child benefit from the ownership interest. We could have trust put in place, and the trust can have any terms that you would want. The trust can be for the life of the children. We can be providing on to the grandchildren to have benefit from this. This also, putting interest in trust is beneficial, especially if the children are just starting out. This can act as a form of an asset protection trust for the children, which protects the children from future creditors, from problems with spouses, and even from themselves. In our trust terms, we can do anything. We can keep it in trust for the children for their entire life, make sure it goes on to the grandchildren. We can put the trust, oftentimes what I see is for a number of years, that certain milestones, more ownership interest would go out to the children, or it would move from trust to them outright. A great tension can exist when we do have children that are very active in the business and have been active with their parents since day one, and then we have other children who took different routes, but we also want to have them share in this wealth that has been built up over the family. So this certainly is time when we have to work with our entire team of financial advisors to find what other ways can we have for, in effect, compensating this child, whether it is through some type of insurance, an insurance trust, whether there is a trust for their benefit that perhaps the active child is in the business that manages for them, and if we're putting it into trust, then that child that is active in the business is held to a fiduciary standard, and we would put safeguards in there to do the best that we can to make sure that the transition from one generation to the next goes well, and that we identify any stumbling blocks and try to account for them, because of course our goal, if we are passing this business on to the next generation that the senior level has worked so hard for, we want to make sure that we do what we can so that the succeeding generation gets along and that we don't end up in litigation as a result of that. We also should keep in mind, as we are devising a way to be transitioning to the next generation, is to make sure that our surviving spouse is accounted for. We don't want to have our spouse, perhaps at the age of, let's say, 65, all of a sudden being the beneficiary of a trust with her children as trustees. That can make for a very difficult transition. Sometimes it works out well, but again, it goes on the specific the dynamics of exactly how the family works, that oftentimes we have the surviving spouse as a co-trustee, so to give them the same level of responsibility as the child. But again, that's why it needs to be very specific for that family. Oftentimes, we also can do a combination of gifting to a child that is active in the business and then doing some form of sale so that that child actually has skin in the game, so to speak. That we will do such things as an installment sale. We can do it with a combination of planned gifting, or that perhaps we can say to the child, we are going to set up this installment sale. Again, we've had our valuation done by with a solid appraisal. Remember, we're going to have to do some type of gift tax return that is going to have the evaluation included with it. We do an installment sale. We can forgive some of those payments. Again, this is all going to be structured as best fits that specific client. And keeping in mind, of course, and this is what Mike is going to be talking about after me, all the tax ramifications that are associated with this. If it doesn't make sense for to be selling 100% or gifting 100% to a family member, that oftentimes we can, perhaps there is an employee that makes the most sense for this to be going to, that and this can be often a combination of, if we have strong employees that need to be there to be helping the children as this goes to the next generation, oftentimes our transaction can be a combination of gifting to the children and then bringing in an employee as an owner. The most common stumbling block to that, bringing in our employee, is the ability for that employee to be raising capital. Again, sometimes installment sales make the most sense. It is very important, as we'll discuss, and I know as Mike will discuss later on, the due diligence and the details of the transaction are very important to make sure that we have legitimate guarantees in place, that the collateral is successfully assigned. Again, this will all be very important for your entire team to review. One thing that I have found that can happen when keeping in mind with our New York State business owners who decide to retire to Florida is if they have an installment sale of the business, that their move to Florida and their change of residency from New York State to Florida can trigger an immediate recognition of that installment sale. New York State will be sitting there in Albany waiting for your tax payments each year. When you all of a sudden pack up and move to Florida, now they don't have jurisdiction over you. They're not sure that they are going to be able to collect that money from you. Therefore, that will trigger an immediate recognition of that gain. So you may not even have received that money yet, but you're going to have to recognize it. So that certainly is something to keep in mind. So when we are selling the business, that's why it's very important to have a leader such as Tom on the transaction who knows where you expect to be 5 years after the transaction to make sure that we have everything in place so we don't have something unexpected, such as an immediate trigger of the gain that you thought you were going to recognize over a number of years. As Mike is going to speak about in a minute, due diligence is very important when we are selling to a third party. Too many times I have heard that we trust this person, and therefore we're going to use the same attorney and we'll draft the documents. And that all, in the perfect world, that certainly is fine. It's not my goal, as much as I like to have full employment of all attorneys. It certainly is not always my goal, but I tell people that when they are going through a transaction, the due diligence is very important, if not even so much for their sake, but for the next generation or for their spouse that they hope to be passing this wealth onto. And that's why due diligence is very important. And as Tom spoke in the beginning, the other key issue that I find people stumble over is the giving up of control. If we are selling to the children and they're going to have 100% ownership, we need to be able to walk away from that. If we're maintaining any control, we may very well ruin any tax transactions or tax treatment that we have maintained if we want to keep some type of ownership over it. That certainly may not work for any estate consideration that we've come into. So I would conclude by reminding you, no good deed goes unpunished. We need to do our due diligence as much as we trust the individuals that we may be selling to. We need to be very careful that that due diligence has been done. And while you think a sale agreement should be 1 or 2 pages long, there is a need to have all the indemnifications, the guarantees in place that need to be there to protect you, because we want recourse. We just don't know what is going to happen to the future. Our person that we sold it to could lose one of their key suppliers or clients that they sell to, and their ability to pay us may not be what we had hoped it would be. So that's why we want to make sure that we have options if a transaction doesn't succeed, and why a team approach is very important.
Marianne, thank you. Our final speaker is Mike DeGerber, who's going to do cleanup today. And Mike is the co-managing partner at Bowers. Tom had started off talking earlier about maximizing the sale. That's what his focus is. But Mike's going to tell you the real deal is how much money do you put in your pocket when it's all done. So you better pay attention to the taxes. Mike?
Thank you. I'm going to speak about several topics, and I will move through these slides. This is an overview. We're going to talk about what the seller and buyer want, finding common ground in the deal. We'll touch on the life cycle of the deal, and I've come up with a list of 15 due diligence problem areas the allocation of purchase price and the tax issues related to that allocation, and then if there is some type of earn-out on the deal. The seller would typically want income tax minimization, capital gain tax versus ordinary income. Very important, number 2, minimize interruption of the business during the process. Don't lose focus on the business. A small escrow, the seller typically just wants to walk away and not have to have any clawback. If the seller is holding any kind of paper, then it would have to be a creditworthy buyer. And creditworthiness is important throughout the process because you don't want to go down the road with a buyer that can't do the deal. And the seller does not want to have to be subject to any future liabilities. The buyer is looking for a sufficient ROI, liability protection going forward, and future write-offs. Some of the common areas that a buyer and seller can typically reach common ground and help the deal move forward would be to accommodate each other in tax situations. Many times we can identify tax savings for the buyer that will not affect the tax consequence to the seller and still generate capital gain income. And typically the write-off of goodwill helps facilitate that. We can utilize a section of the Internal Revenue Code called 338H10. This allows for a stock sale legally with the write-offs that come with an asset sale. We want to talk about indemnifications for purchasing liabilities. Make sure that these are typically will even out the stock sale with the asset sale with these indemnifications. Extra value can be attained in the form of an earn-out if both parties are unsure of the future, and the escrow terms will have to be reasonable to work for both. Seller financing often can get a deal done if the seller is willing to hold paper. The life cycle of a deal, this is a very general and probably number 1 that's not here would be hiring your investment banker, your advisor, and then with the help of that banker, identifying potential acquirers, beginning the preliminary negotiations with the buyer or seller, leading to a letter of intent. That letter of intent should always be very specific in most cases. That's where you want to hammer out any potential future disagreements in that letter of intent, whether it's binding or non-binding. The due diligence period and reaching a definitive agreement, and then going to closing and making sure any post-closing issues are addressed in the agreement. The top 15 due diligence problem areas that I have seen typically relate to areas that can be addressed with full disclosure right up front and through the due diligence process. Revenue recognition policies are important to define, make sure that they are in conformity with generally accepted accounting principles and tax code as well as industry standards. The balance sheet is important, whereas receivables and inventories should be valued properly. You don't want surprises there. Accruals and allocations need to be at arm's length and properly reflected in your financial statements. Identification of non-recurring items. Tom mentioned to develop an EBITDA, a normalized EBITDA, and Rick also mentioned that we would add back or subtract non-recurring items. Those are very important to identify. Tax issues up front, as I mentioned, both parties should be totally on board with the tax treatment of the transaction so that both can get favorable tax treatment. Internal control weaknesses need to be identified and addressed. These types of weaknesses can slow a deal down. And inventory, as I mentioned, employment agreements with key people, very important. Keep key people, focus on the business. Most cases we see bonus arrangements being set up with the seller of a business for its key people to keep them focused throughout the transaction, and then the buyer, the importance for the key people will depend on what the buyer's plan is for the business, as Tom mentioned previously. Making sure key contracts can get assigned is important in this process. This could hold the deal up. Related party transactions need to be identified to the extent that those will not be incurred going forward, that they need to be identified and worked through. Management estimates of future income, off-balance sheet items, any unrecorded liabilities, management representations, employee benefit plans to the extent that those plans need to be wound down or transferred to the new owner, and information technology. The allocation of the purchase price is critical, and really what I have to say here is that the seller will want capital gain treatment, and the Internal Revenue Code is very specific on the allocation. If the parties agree, generally that agreement will be respected, and with the proper allocation to goodwill, we can typically achieve a write-off for the buyer and capital gain treatment for the seller. And some things to be aware of with tax issues related to the purchase price allocation. Special circumstances will exist with cash basis taxpayers versus accrual basis taxpayers. Depreciation recapture, that's something we always want to avoid if we can from the seller's perspective, since it will be taxed at ordinary income rates. 197 intangible assets, that's just a name for, typically it's goodwill, and that again can be written off by the buyer and will be taxed at capital gain rates by the seller. Care always needs to be taken when there is an installment sale, as Mary Ann had mentioned earlier with regards to a New York State resident. That is one issue. There are always the issues of recognizing income up front because of the installment sale and the Internal Revenue Code treatment, and then later on not receiving that income and being faced with a shortfall after tax has already been paid. And finally, what is typically needed to get the transaction completed is an earnout, and earnouts are very, I would say, uncommon. However, if you do agree to an earnout, specifics need to be identified as to time frame, who controls the earnout payments, the taxability of the earnout, and how it is calculated. And with that, I think we're going to have some questions, so I'll turn it back to Norm.
Mike, thank you. We do have a few minutes left in the session for questions. We have one question which was submitted I'd like to share with you, and anyone on the panel may respond. It says, I have a successful freelance graphic design business. What are the exit strategies that apply to this type of business? I'd like to leave my clients in good hands. Any suggestions to the questioner?
Well, I've got quite a bit of experience in the marketing area, and the first comment, I mean, it's a standard answer, it depends. Depends on the type of business you're in. In this case here, you're in the graphics business. I would look to another graphic business to merge with, form a partnership initially, and then work out some type of agreement over time where they could buy you and your clients out. Another might be where you find a marketing organization that needs a graphics design person, and you could sell your company to them and become part of their company, again with the agreement over time to sell out. But it's one of the more difficult transactions because the asset is pretty much your capabilities to drive revenue and income for yourself and others. A lot of times we'll look for areas that you can actually cross-sell and sell other services into your existing client base as well.
Okay, thank you. I have another question. Are most of these deals asset sales or stock sales, or how do you make the determination? Rick, you want to try that one?
It really depends on what the business is, but especially in capital-intensive industries, it's mostly asset sales. We see a lot of asset sales. unless there's very specific reasons for liability issues or transfers that we see stock sales, but mostly asset sales I see.
Okay. One of the questions I come across from business owners all the time is the question of, obviously they want to do what Tom says, I want to maximize my sale price, and then on the tax I want to minimize it, and on the estate side, so you've got different valuations. Mike, how do you address that question? What do you do when you want to maximize your sale income, and for estate purposes you want to minimize your taxes?
Well, I think
for valuation.
You want to see Marianne very early in the process and start a gifting program. So that's really what it's all about, is to start this process very early, set up the entity properly, utilize trusts if the business is going to grow, and because by the time you're at the table to sell, you know, that price maximization is probably going to be most important.
Okay. Tom particularly, I know, is focused on mid-market companies. The people who are here, I think, their expertise is in the mid-market. On the low end of the mid-market, on the smaller companies, there's always a question. We talked about the seller as the banker in terms of holding paper. How often does that occur? We've talked about the pitfalls of that, but how often does it actually occur where you have to hold part or all of it? I assume in mid-market it's cash and stock.
Yeah, I have found the SBA loan process is really the best avenue for a buyer, and I advise sellers to really, let's try to cash out and truly take that cash, and if they're moving to Florida, not to read it as an installment sale where you're going to be getting cash over time because of the potential liability and tax implications of having to pay that. So again, it goes back to the old, it depends, but in most cases, the advice I give to sellers is to look for that cash deal and have that banker, good relationship with your banker so that you can introduce your banker to the potential buyers and help them set up with the SBA loan process and other instruments that are available to help facilitate the sale. I always look at that as the last worst case scenario, is to hold paper.
Okay. Well, we've come to the end of our session. As you can tell, there is a lot of ground to cover here. We covered it very quickly. Again, I want to point out that we will be sending you a link to the presentation and strongly advise you, if you're looking at this process, you need to spend a lot of time and do your planning carefully and be sure that you really do have a team of experts.
Again, I'd like to thank the Madison One Clearinghouse Network for their sponsorship today, as well as MACNY, the Manufacturers Association of Central New York, for helping us to propagate the invitations and to get several of their business owners to sign in today. If you have specific questions, all of our contact information is in the presentation. Feel free to reach out to any one of us. Again, we'll continue to maintain the confidentiality of your presence here today, and good luck. Thank you.